I'll give you 50 cents tomorrow for a hamburger today. If you grew up watching the classic Popeye cartoons, you'll definitely recognize that as his pal Wimpy's go-to line. But seriously, take a second and actually think about Wimpy's proposition. Is that a good deal? You're giving up something of real value right now, a juicy hamburger, for the mere promise of money in the future. It sounds like a simple cartoon joke, sure, but it actually hits the nail right on the head of one of the most fundamental questions in finance. How exactly does time mess with the value of our money?
Welcome to This Explainer. If you're someone who loves to dig into the mechanics behind the decisions you make every single day, well, you are in the right place. Today, we're going to unpack the practical toolkit of time, risk, and opportunity cost. We'll look at why a dollar today is absolutely not worth the same as a dollar tomorrow, and how grasping that one simple relationship can be a total game changer for your financial future. Think of this as your survival guide for future money. Here is our roadmap for today. Valuing time, the math of money, the lottery dilemma, projecting futures, and finally, evaluating risk. Let's get right into it. Kicking things off with part 1, valuing time, and the concept of distance from liquidity. Think of time as this thing that literally puts physical distance between you and your cash. When your cash flows happen in the past, they're sunk. Done. When they're in the present, they're liquid, meaning you can use them right now. But if those cash flows are stuck out in the future, they aren't liquid yet. And here's the kicker. You can only actually make choices with liquid wealth. Being separated from your money by time means you can't use it to buy things or invest it today. That separation, that's what creates an opportunity cost. To really wrap our heads around this, let's define liquidity. Basically, it's wealth you can use without paying extra transaction costs, dealing with opportunity costs, or taking on risk. Picture this. You travel to Mexico. You've got a fistful of US dollars, and you smell the most amazing taco stand. You're starving, right? Now, you technically have wealth, those dollars, but you don't have liquid wealth for that specific market. To buy those tacos, you got to track down a currency exchange. That takes time. They're going to charge you a fee to swap your dollars for pesos, and there's a real risk the exchange rate is completely terrible. Converting your not-so-liquid wealth into liquid wealth costs you, and that is exactly why having liquidity right now is incredibly valuable. Moving into part 2, the math of money, present versus future. So, quick question. If your grandparents promised to hand you a $1,000 gift for your 21st birthday next year, what is that actually worth to you today? To figure that out, we need to compare two major concepts. On one hand, we've got present value, or PV. This is simply your liquid value right here, right now, in the present. On the flip side is future value, or FV. This factors in how time affects your cash. The equivalent present value of a future gift will basically always be less than its future face value. Why? Because waiting around for that money literally costs you. Let's clean up the math on this. Imagine you had that $1,000 right now, today, instead of next year. You could toss it into a bank account earning, say, a 4% interest rate. In 1 year, your money naturally grows to $1,040. In this scenario, that 4% interest is your discount rate. It represents your opportunity cost, the exact amount of money you're missing out on making simply because you don't have the cash in your hands today. So here is the absolute crucial takeaway. Time discounts value. As the time separating you from your money increases, its present value decreases. And if your opportunity cost, your discount rate goes up, waiting hurts your present value even more. The strategic implications here are huge. All things being equal, your goal should always be to accelerate incoming cash and decelerate outgoing cash. Get paid sooner, pay later. Wimpy honestly had the whole thing totally backward. All right, part 3, the lottery dilemma, lump sum, or annuity. Let's apply all this math to our first high-stakes scenario. I want to put you right in the driver's seat for this one. Imagine you just hit the jackpot. You won $10 million in the lottery. The agency gives you a choice. You can take $500,000 every single year for 20 years, or you can walk away today with a one-time lump sum of $6,700,000. Wait a second, why is the lump sum so much lower? Well, because the lottery agency totally understands the time value of money. They discount the lump sum because they'd much rather hold on to their own liquidity longer and invest it themselves. So what's the better move for you? The answer depends entirely on your personal discount rate, your opportunity cost. See, an annuity is just a series of equal cash flows over time. If you don't have any great investment options out there and your personal discount rate is super low, let's say 2%, the present value of that 20-year annuity is actually over $8.1 million. Mathematically, it absolutely crushes the $6.7 million lump sum. But what if you're a savvy investor? If you can reliably earn, let's say, 8% on your money somewhere else, waiting 2 decades for your payouts is wildly expensive. At an 8% discount rate, the present value of that annuity drops to just $4.9 million. The magic threshold here is 4.16%. Basically, if you can confidently earn more than 4.16% on your own, you grab the lump sum today and run. Now, okay, most of us aren't winning the lottery anytime soon, but this exact logic applies everywhere. Any regular payment you make or receive at regular intervals, that's an annuity. Your monthly mortgage, installment purchases, retirement payouts, even your standard biweekly paycheck. The exact same rules of time, risk, and opportunity cost govern all of these everyday cash flows. Moving to part 4, projecting futures, Alice's gamble. Let's look at a slightly more relatable, high-stakes scenario. Alice is drowning in some heavy student and car loan debt, and she's weighing some pretty extreme options to dig her way out. To figure out her best move, Alice needs to use what are called pro forma financial statements. You can think of these as a kind of financial mirror. They let you peer into the future consequences of your choices by projecting your income, cash flows, and balance sheet forward, all based on a set of specific assumptions. So Alice models out 4 distinct choices, ranging from totally safe to incredibly risky. Option 1, just continue as normal, slowly paying down the debt. Option 2, hustle, get a second job, and throw that extra income straight at the loans. Option 3, go to Vegas, gamble everything she has, and win enough to wipe the debt out completely. Or option 4, go to Vegas, gamble it all, and lose. Let's see how this actually plays out on her projected balance sheets. If she just continues as normal, she slowly chips away at the debt. If she takes that second job, her net worth grows way faster. But the Vegas options? Well, if she wins, her debt instantly drops to 0, and her net worth skyrockets to a positive $54,590. Sounds amazing, right? But if she loses, she actually has to borrow money just to cover the loss. Her total liabilities quadruple to over $150,000, and her net worth plummets to a negative $145,660. Ouch. When we pull back and look at her bottom lines across the board, it paints a really stark picture. Taking that Vegas trip creates both the absolute best and the absolute worst strategic scenarios for her financial future. The second job? That's a guaranteed, certain improvement. The Vegas trip is pure volatility. And that volatility brings us right to the final piece of our puzzle. Which brings us to part 5, evaluating risk, the coin flip. How on earth do we actually analyze the deep, terrifying uncertainty of Alice's Vegas gamble? Think about a simple coin flip. It perfectly illustrates this idea of independent events. You have a 50% chance of getting heads, and it doesn't matter how hard you concentrate or cross your fingers, you cannot physically will that coin to land on heads. The outcome happens entirely by chance. Alice can choose to drive to Vegas, sure, but she cannot choose to win. Risk in the financial world is all about these independent events where outcomes just can't be forced or chosen, no matter how much we want them to be. We can only project our expectations based on probabilities. And when risk is high, holding onto your liquidity in the present becomes even more vital, because there's a very real chance your big future payoff might never happen at all. So I'll leave you with this final thought. You've got the toolkit now. You know that time puts distance between you and your money, that opportunity cost discounts its value, and that risk threatens whether it will even exist. The math is clear. $1 today truly is worth more than $1 tomorrow. So the next time you're faced with a choice, whether it's taking a lump sum, waiting for a payout, or even taking a wild gamble like Alice, stop and ask yourself, how will time, risk, and opportunity cost dictate the true value of your next big financial decision? Are you going to be a wimpy, or are you going to command the time value of your money? Thanks so much for exploring this with me.